A low advertised weekly repayment can hide thousands of dollars in extra fees, compound interest, and a massive final balloon payment. In the next few minutes, we will walk through exactly 8 hidden costs you need to audit before signing any car finance contract in Australia. Dealerships and lenders heavily advertise that tiny weekly figure to make the purchase feel effortless. It creates pressure to sign the paperwork today, without forcing you to check the underlying math. But getting approved for that specific weekly amount does not mean the lender has determined the vehicle actually fits your real day-to-day budget. That weekly number is engineered to get the car off the lot today. You are the one left holding the actual financial risk for the next several years. The reality of your debt starts in the dealership finance office. This is where the final price of the vehicle is structurally inflated before a single percentage of interest is even applied. Cost number 1 is the actual amount financed. If you still owe money on your trade-in, rolling that negative equity into the new contract means you avoid paying cash up front, but your starting debt instantly exceeds the new car's value. The true amount you borrow is the vehicle's price plus financed additions like negative equity and fees, minus your deposit and trade-in. That brings us to cost number 2, the rate. You have to distinguish between the advertised headline interest rate, which looks incredibly low, and the legally required comparison rate, which factors in the standard fees. This leads directly to cost number 3. Choosing a loan specifically for its low advertised rate often means the lender is compensating by attaching heavy upfront establishment or broker fees. When upfront fees are capitalized into your loan balance, you pay long-term interest on the fees themselves. Look at the comparison rate. The loan with lower initial interest actually costs more money once fees are factored in. Relying purely on that headline interest rate blinds you to the heavy upfront costs secretly capitalized into your total debt. Once you drive away, the dynamic shifts from a one-time transaction to a rigid, multi-year commitment of continuous monthly payments. Cost number 4 involves ongoing and default costs. Automated direct debits are convenient, but if you run your account without a cash buffer, that convenience turns into a serious liability. A single missed payment triggers a cascade of dishonor fees, default interest, and leaves a permanent mark on your Australian credit report. Cost number 5 requires choosing between a fixed or variable rate. Fixed loans lock in your repayment amount for certainty, whereas variable structures offer flexibility to pay off the debt faster. But that fixed certainty comes with an early repayment trap. If you need to sell the car early or leave Australia, clearing that fixed debt early often triggers severe break fees. The financial convenience and certainty you secure upfront can transform into strict administrative penalties the moment your life plans deviate from the scheduled term. To keep that weekly payment aggressively low, lenders deploy specific structural tactics that backload your financial risk. Cost 6 is the balloon payment. Steady payments lead to a massive final lump sum. It lowers weekly costs, but leaves a huge debt. If the car depreciates, this balloon becomes a trap, leaving you owing more than the vehicle is worth. Some manufacturers offer a guaranteed future value to mitigate this depreciation risk. However, it strictly limits how you use the car through rigid kilometer caps and heavy wear and tear conditions. Cost number 7 involves optional add-ons. You will often be aggressively offered products like tire and rim cover or paint protection, framed as necessary for your peace of mind. The trap is financing these add-ons. You end up paying years of compounded interest on overpriced products that frequently duplicate coverage you already have under your comprehensive insurance policy. Slashing the weekly payment through balloon structures and financed add-ons does not save you money. It simply delays and exponentially inflates your final bill. Beyond the structural math, you have to evaluate the timeline of the loan against your personal eligibility and residency profile. Stretching a loan out to 7 years is a standard tactic used to achieve the absolute lowest weekly payment possible. The trade-off is that you maximize the total interest paid, remaining locked in debt long after the vehicle has substantially depreciated in value. For temporary visa holders, this timeline is critical. Eligibility depends entirely on your specific visa expiry and income. No lender guarantees universal approval. If you are rejected, avoid the desperation tactic of submitting multiple rapid-fire applications. Each rejection places a hard inquiry on your credit report, destroying your future odds of approval. Keep Keep in mind that most of these are secured loans, meaning the physical vehicle serves as the legally registered collateral for the debt. The worst-case scenario is simple. If you default and the lender repossesses the car, the sale price rarely covers the balance. You are legally required to pay that remaining shortfall. Pushing the boundaries of loan terms and visa eligibility to secure a car today leaves you fully exposed to a catastrophic shortfall debt tomorrow. Eventually, the paperwork is done, and you take on the inevitable, ongoing financial burden of real-world mechanical maintenance. This is cost number 8, the expenses outside the loan. Budgeting only for the finance repayment ensures the lender is paid, but it ignores what it costs to actually stay on the road. Once you add in stamp duty, registration, compulsory third party, routine servicing, and comprehensive insurance, a financed car can quickly become unaffordable in your daily life. Before you sign anything, execute this final defensive checklist. Compare at least 2 loans, check the comparison rate, add up all the fees, calculate the total payable amount, and read the exact payout and the loan conditions. Explicitly calculate that total amount payable, not just the weekly rate, using the independent calculators available on the ASIC Moneysmart website. Keep in mind, this information is general in nature and was verified on the 20th of July, 2026. If you experience financial hardship, contact your lender's internal dispute process first. If it remains unresolved, you can escalate it to the independent Australian Financial Complaints Authority. The only way to survive the repayment illusion is to strip away the marketing, calculate the absolute total cost, and ensure the contract actually fits your reality.